Louise Bedford here, the Money Chick and the host of the Talking Trading podcast. This is how traders excel. We are going to kick off the year with fresh insights and expert opinions from Henry Jennings. Now, Henry Jennings is the senior market analyst at Marcus Today and host of the On the Couch podcast. I've been on Henry's show many times. He's been on my show many times. And even though he's a complete fundamental trader, he brings an insight that is of a technical nature to the markets. I love the way he thinks. I love the way he operates his podcast. And you are going to get so much out of hearing our views about how to get 2025 set up from the beginning in the right way as a trader thinks, as well as hearing about how small and mid-cap stocks are going to be your secret to doing successfully in the markets this year. So let's get rolling. Henry, welcome to the show.
Hi, Louise. Thanks very much for having me on.
I'm so excited that we're going to get to compare our thoughts for the year ahead. 2025 is a big year. I love that you are specialising in small to mid-cap stocks because I do think that is going to be a key area for our traders to look at. Give me an idea about what your outlook is for the year.
Well, I have to say, Louise, it kind of changes by the minute. We do have a mercurial new leader of the free world. And unfortunately, he has certainly gone pretty hard in the first week or so of his presidency. So things do change very much so. But, I think for the Australian market, which in 2024 was dominated, I guess, by one real story, which was the banking sector that has been extraordinary, especially in the last 6 months of the year, has really crushed all before it. And really, that's been a function of Commonwealth Bank and National Bank to some extent, and not so much from a profit perspective, but more from just an expansion of those PEs. And I think that's going to be interesting to see how that unfolds as the year progresses. And of course, what we have seen as well in 2024 is the resources have languished, and with the exception, I guess, of gold to some extent, but certainly resources have languished. So 2025, I am hoping and think that maybe we will see somewhat of a reversal of this. It doesn't necessarily mean that the index is going to hit 10,000 or 9,000 or whatever, because our index is so skewed to the top 10 stocks. But as far as the ASX 200 goes, I would imagine that we'd finish mildly positive for the year, but it that could change at any second, really, Louise, I have to say at the moment. But, I think we've seen this massive shift away from resources into banks. If we do see Donald Trump go easy on China, have a bit of a détente with President Xi, then we could see that stimulus come through in China, and we could see the resources do much better. So that, to me, is kind of the key, I guess, going forward in 2025, is this balancing act between the two. So, yeah, it's it's such a fast ride at the moment. Only last night we had the whole AI kind of story unwinding to some extent, with Nvidia falling 17% on the back of this new Chinese AI bot R1 coming out of deep state. So deep state, is that the right word for it?
Deep seek, yes, close enough. Yes,
deep state is probably the better way of putting it, but deep seek, seek and you shall find. So no, I think it's going to be, as they say, an interesting year.
Because that was the other sector that did very well in 2024. It was continually a hot sector. That IT sector was always coming up on my scans as that relative strength comparison heat compared to the rest of the market. But this is going to change the game somewhat. It will be interesting to see. The other thing I wanted your thoughts on here is that with Australia moving to a slightly different outlook for the US, this could actually impact our traders. And what I'm talking about here is we know that at some stage they're scheduling this for the second half of 2025. They're saying that the American market is going to trade 23 hours instead of us having to stay up all night and get ourselves defogged and put on those trades on the American market.
Yeah.
I would love your thoughts on that. Sure, we've got ever-changing circumstances and things do end up being like that sink or swim feel. But that movement to 23 hours of trading, how is that going to impact our Australian traders?
I guess there'll be some sleepless nights in some respects. I mean, the thing is that the US market has been all conquering, hasn't it? 75% of global markets now are the US. I think Australia's down to sort of 1.2, 1.3% of the market. And there's no doubt that this talk about American exceptionalism, the high tech, the tech behemoths, the Metas, the Amazons, etc., have really carried all before them. And you have to question, and I guess a lot of people have, why would you bother trading a small and relatively obscure, to some extent, Australian market with all its pitfalls when you could trade the US 23 hours a day? We've already got crypto trading 7 days a week, 24/7. We've got foreign exchange, which trades pretty much 24 hours a day as well. So it's inevitable that I guess the US goes to 23, 24-hour trading. To some extent, depending on your platform, you can already get that kind of exposure. Similarly, I used to work for an investment bank, and we used to hand our book from Sydney to London to New York, and it came back again, and we would be making prices overnight to institutions. So we were effectively trading 24 hours a day anyway. The Australian market's got gentleman's hours still, 10 till 4, which is quite rare. Asian markets even close for lunch, which I think is a fantastic thing, and we should certainly bring that back in the ASX. But America has just been this magnet for funds, and a whole new raft of investors, especially younger ones who identify with American stocks, know those names, have been really pulled towards trading US, trading crypto as well. And poor old Australia gets a little bit forgotten in all this. So volumes can, and they certainly haven't been exactly stunning, have they? The ASX hasn't done a particularly great job. We've had no really great IPOs that have come along and really sort of fired the imagination up either. So it's a bit of a backwater. That's the problem, Louise. And I look at Australian stocks and ASX stocks, and you're kind of feeling, you're missing out on this big party. But then, there's certainly plenty of money to be made in Australian stocks, ASX stocks. Certainly plenty of money, and the same rules apply to our stocks as they do to the US in terms of investment strategy, technicals, and fundamentals, etc.
They really do. I like that it feels familiar to trade a US stock if you're used to trading an Australian stock. There are a couple of little alterations that I'd suggest, though. So as you know, Henry, I use a macro filter to tell me when to trade and when to stand back from the markets. So I do think applying that macro filter over the All Ords the way that I do makes intuitive sense for the Australian market. But I do actually counsel my traders not to apply that same macro over the Dow, because there's only such a small number of shares in the Dow, not even over the S&P 500, because there are so few that are valued at under $100 for each stock. So in terms of bang for your buck, you're not getting a lot of traction scanning the S&P 500. I do like scanning the Russell, because with the Russell being that mid-cap level for the US stocks, that presents a lot of opportunities. And it is something that I think with your background, that would be an instant Venn diagram tick for you, Henry, wouldn't it be? Would the Russell be your key index for the US?
I guess to some extent it would be, but the Russell 2000 is kind of small and mid caps, but their idea of small and mid caps is they're actually, by our standards, they're pretty big.
Correct.
That's the thing about America. Everything is big, let's face it. I think their average sort of market cap for the Russell 2000 is 3.5-4 billion US dollars, which that's the average. So our small caps are considerably smaller than that to some extent. So it's also the other thing about the Russell is it's got a preponderance and it's got a big bias towards sort of second tier financials as well, which obviously under Trump, with deregulation or lack of regulations for the banking sector, has done very well. And it's always seen as kind of a benefit from lower interest rates as well, because they're smaller companies and more sensitive, I guess, to the leverage in terms of interest rates. So it is an interesting index, that's for sure. And it has been languishing for a long, long time. It's paid a bit of catch up recently, but I did see some statistic. I not sure if I'm right, but the S&P 500, if you took out the big sort of the top 10 stocks, and the average return on the S&P 500 is about 12% down. So, the US, like our own market, has really been skewed to these mega cap stocks, the Nvidias, the Apples, not so much maybe to Apple, but, very much skewed to the performance of these mega caps. And hopefully, and this is, I guess, one of the thoughts with this shakeout that we're seeing in AI at the moment with Nvidia, etc., with the deep state or deep seek, with the new chatbot technology, that it may broaden the rally in the US. It may force investors to go, you know what? Maybe it's not all about Nvidia. Maybe it's not all about AI. Maybe we need to look further afield in terms of the US, because, let's face it, Donald Trump is a very pro-business president, probably more so this time round than he was in 2016. He has a lot more power, I guess, and he's a lot more used to having that power, as we've seen with the signing of a Sharpie pen. He can change the landscape quite extraordinarily. I think this time round, pro-business and pro-small and mid caps in the US is probably going to really be good for that Russell 2000.
So if you're listening and you are not feeling that you're equipped to trade this, now is the time. You have got time before it goes to 23 hours. This is where you start looking at your trading accounts and getting them set up so that they can trade US stocks. It's also where you start getting your head around looking at those charts, if you're looking at the technical side of things, to see what they look like. A few of your scanning parameters will have to be different. As Henry said, like the dollar value of these stocks can be quite large compared to our market. So start getting your head into the arena, start looking at that market, because it will be a viable alternative if you haven't traded it before for 2025. I do think also, and I'd love your thoughts on this, Henry, I do think what is going to happen is that when the US opens up the timing, the money will start flooding into the US market, because all of a sudden it will encourage traders who haven't previously thought that they can invest in the US market from around Asia, especially Australia, New Zealand, right in our home turf. We're going to be looking for places to put our money in that market. So I'm guessing, and this is a guess because we are speculating on the outlook for 2025, but I'm guessing there will be a flood of money coming into the US. And for you to be best situated for that, you need to start making plans now. Your thoughts, Henry?
Yeah, I mean, I think, Louise, we've seen a massive amount of money flowing towards the US as it is. I mean, Europe is we've seen Germany, the DAX at pretty much record highs, but Europe politically and economically has certainly been struggling. Asia, of course, you've got China with its problems. Japan is probably a little bit unknown for certainly for Australian investors, individual stocks there. So the natural place for people to invest has been the US, and we've seen massive inflows into US ETFs here, massive inflows from around the world, I guess, into technology stocks. And this is, part of the reason why Nvidia has been on such a massive run. I think it's still up sort of 90% in the last year, despite falling 17%. It's that weight of money, that momentum that we've seen going into US tech stocks. It has been a magnet for capital. If they open 23 hours a day, that magnet is just going to get bigger and bigger to some extent. So we are going to see funds being sucked into the US. And I guess it's inevitable that other bourses, other stock exchanges will move towards that as well. Maybe the Australian Stock Exchange will open until 5 o'clock and be really radical, or even open at 9. Who knows? But, we shall see. But, it's interesting. The LME, for instance, London Metal Exchange, they have a ring where it trades for 5 minutes in the morning and 5 minutes in the afternoon. I mean, that's a very archaic way of doing things. Of course, most metals trade outside of the LME ring as well. So there's going to be a lot of duality, I guess, in terms of the exchanges. You can still buy BHP in New York. You can buy it in London, obviously through ADRs, etc. So we do have a certain amount of that trade already. But, the US market is becoming so big. it's conceivable, I guess, that in a year or two's time, we could see, if the AI thing continues, the US 85% of global markets, which would be all crushing, I have to say. So that shift towards the US with money will just continue.
And where there is observation, there is opportunity. So one of the things I think you could look at, even if you're not prepared to invest directly into US stocks, that you could investigate, is looking at ETFs. ETFs are a massive, massive thing to trade. It's exchange traded funds. If you haven't looked into them, what it means is that it's looking at instant diversification across an industry index or a type of group of shares where it acts like one trade, but going through where it's comprised of many trades. So, for example, if you trade one of the NASDAQ ETFs, then you are getting exposure to the NASDAQ, but without buying the individual trades of the NASDAQ. Now, one of the pieces of advice that I give my traders in my mentor program is that make sure that if you are looking to get involved with an American-based ETF, is to make sure it's domiciled in Australia, because it will behave the same way. The correlation is very high with an American-based ETF that's domiciled in the States, but you don't have to fill out those disgusting WBEN forms every 3 years and continually do that administrative paperwork, which drives me crazy. So that is something that I think traders could do to get themselves set up for 2025 and presumably this trend continuing in the US. What are some other things that traders should do to get themselves set up for this year?
Well, I guess ETFs are a fantastic way to go, as you say, Louise. All I would say to people, if they're contemplating ETFs, is read the small print. It's very important to know what you're buying. A lot of the more esoteric and the exotic ETFs are based on indices that people, that an investment house will kind of make up as they go along, and they'll call it something, something grandiose, etc. But it really is kind of a made up basket of stocks. And these are more active ETFs. It is more kind of a black box. And sometimes the theme itself doesn't actually kind of relate to what the stocks are underneath. So I think it's very important to make sure that you're looking at the ETF, the actual composition, where you're getting exposure. Because if you're buying an ETF that you want to have tech exposure, for instance, the AC/DC, which is, battery tech, and the lithium kind of ETF that is listed on the stock exchange here, a lot of the components of that are car companies. Now, you may or may not want that exposure to car companies. It sounds great because it's sold as a battery tech kind of ETF with lithium exposure, but a lot of it is kind of skewed towards some of the old school car companies. So just read the PDS and make sure that you're buying what you think you're buying, and it's not all just, people put together a basket of stocks and a basket of ETFs, and they look at it on the Venn diagram and realize that they've got NVIDIA in every single basket. And if NVIDIA takes a 17% plunge, then, it's going to affect not one, but all of their ETFs, and that diversification kind of goes out the window. So that's something to be aware of.
Yeah, such a good point. That is really a good point, because the ones that I've tended to head for, and I'd like your thoughts on this, is the ones that have a similar composition to the primary index that I'd be looking to trade. So as an index trade, make sure that it is representative of that index, and also make sure that they have enough funds under management so that you're not going to be caught out. The magic number for the ones that I'm choosing is $250 million for that figure. They have to have that under their belt before I'd even consider them.
Yeah, I mean, most of the providers of ETFs, regardless of the actual size of the funds under management, they've got market maker arrangements. They're not like LICs, which can trade at substantial discounts to their NTAs. The arbitrageurs will step in and buy it at a discount and sell the underlying assets in the right ratios and replicate the ETF, and therefore those discounts don't really exist. But certainly some of the small ones, and there was one launched, I think it was last week, which is the first long short ETF in Australia called Alpha, and that one looks kind of interesting. But some of these take a little while to be established. But I think also when you're looking at ETFs, it's important to make sure that you've got the right bet as well. You're not taking necessarily a currency bet. Some ETFs are in US dollar denominations, some are in Aussie dollars, so they've got a hedge in there. There's nothing worse than getting your view right on US tech and finding that because the currency has moved, your view has really made you no money at all because of that currency component. So I think it's very important to read and get yourself acquainted with ETFs, because they are marvelous investment opportunities, but they have to be understood as well, because there's a lot of Johnny come lately issuers that, if it's a new trendy thing, they'll come up with a 4-letter stock code, off we go to the races, bit of marketing, and Bob's your uncle. But sometimes you're not getting what you think you're getting. So just be careful out there with those ETFs. The normal ones you're talking about, Louise, like the NASDAQ or S&P 500 or the ASX 200, those are all pretty vanilla, but there are some non-vanilla ones out there, even some of the leverage ones, some of those, the leverage plays either on the ASX or on the US market, they have ratios that can change, and they're not really designed for long-term investment positions. There's better ways to hedge a portfolio than a bare ETF, perhaps on the ASX or on the US market, because they are based on futures prices, and futures prices can jump around as well. So you might not end up with the return that you want, or the hedge that you want over a long period of time.
Oh, Henry, you're just speaking my language. And do you know the thing as well is, if you are a beginner in the stock market and everything that Henry and I have just said has gone whoop over your head, please give yourself time. This is the beginning of a new year. There are so many things that are good that are waiting for you. Part of the idea behind being a new trader is to stay in the arena long enough so that these definitions become second nature to you. So don't just tune out because we've said a lot of big words here. Please give yourself time to grow and to think in our way of thinking, because there is money to be had. Now,
Yep.
Henry, I'd love to hear your thoughts about where traders should set themselves up emotionally for this year. How do you think traders should gain balance this year?
I think it's going to test the emotions of most traders this year. I think what's important though is to try and try to get the noise out of your brain. There's so much information out there. There's so much data out there. There's so many people trying to flog you things. It's going to be extraordinary. Couple that, of course, with the move fast and break things, which Donald Trump is clearly embarking upon. It's going to be a very hard year to try and get that noise out of your head. I think you've got to keep your eye on the prize. You've got to keep your eye on the horizon. When you're in a boat and you're getting seasick, the best way to cure it is to keep your eye on the horizon and not trying to look at the deck as it's moving below you, because that can be very detrimental and you'll end up chucking up over the side. So try and keep the horizon in sight. Try and keep the fact that ultimately the US is pro-business. Ultimately the US is pro the US at all costs. I mean, the US will do what's best for the US. That is really the nature of the beast, and everybody else can really have to fall into line, and we've already seen that. So I think it's emotionally we have seen markets. I think the rule book to some extent, Louise, has been thrown out in the last 3 or 4 years in terms of what constitutes normal markets. I think we've got to a new normal. When I started in this business, God knows how many years ago, there was fundamental analysis. Things moved at a snail's pace compared to what they do now. Computers now are generating buy and sell orders across multiple assets with AI models that are moving so quickly. Momentum has become far more important than it was ever. I think 10, 15 years ago, momentum is massive, and fighting and swimming against it's a bit like being caught in a rip. Fighting against the rip is going to end up with you drowning. Whereas if you go across or you go with it and allow the rip to take you to where it should go, and then you can swim back into safety, has been far more profitable. Following the money, following the herd has been far more profitable than trying to be a contrarian. And I guess, we've seen it with a number of funds that I follow, long short funds. They've really struggled in the last year or two because their whole method of being long something and short something else has really kind of failed because the shorts have gone up and the longs have gone up, and it's kind of negated the whole performance of the fund. So, I think momentum and the speed which things change, it has a tendency to make us all a little bit seasick. But just try and concentrate on the prize, which is obviously making money, and get that noise out of your head. And maybe that means going for a walk, taking the dog for a walk, and getting away from the screens every now and then, trying to get that balance in your life, sleeping well, eating well, exercising, all that sort of stuff that's good for your mental health. Because I think, as they say, buckle up, because I think this year we are going to see increased volatility in the market, and that is going to be both good and bad. It does throw up opportunities, which is great. Volatility. I love volatility. I'm an old options trader, and to me, if the market goes quiet and does nothing, that's just Yawnsville. But if it's moving around and you're getting opportunities not only to buy but also to sell, that is good news, because that momentum works both ways. It takes stocks up to ridiculous highs, and it takes them down to ridiculous lows. And you, as a trader, as an investor, if you can look through the noise, then you can make seriously good money out of those two extremes.
Yeah, absolutely. And I think one of the other things that traders have to be very aware of this year is to follow their trading plan. Now, if you don't have a trading plan, you need my trading plan template. So come to my website, which is tradinggame.com.au, tradinggame.com.au. Download my free trading plan template, because that will give you all of the areas that you need to be able to create a trading plan that is robust, covers all of the situations that you need to cover, and really gives you that horizon, as you said. I want to get back to one thing that you mentioned, though. Is our goal to make money? Now, I know overall, yes, Henry, we want to make money. Of course, that is the utopian view. That's why we're entering the market. We're optimistic people. We think that that money is within our grasp. But I have to say, the traders that only think about making money are the ones that get thrown around by those vagaries of the market. So I prefer the goal to be to follow my trading plan without question. So firstly, to develop the trading plan if you don't have one, but secondly, to follow it without question, so that you can be that disciplined, focused, very experiential learning type of trader, where you are using that data, feeding it into your plan, and it's got that beautiful feedback loop of reality if you've got enough data to be able to feed back into it. The difficulty I see is that traders make a trade, make two trades, and they provide conflicting information. And before you know it, that trader is stuck not knowing what works. I think that indecision can really be a source of stress for traders. Henry, have you seen that in your traders?
Yeah, I think one of the mistakes that that traders make is that they feel that, if you're not trading, you're not a trader. And that is probably wrong. Over trading is really, really dangerous, thinking there's a trade everywhere. Most of the the guys that I worked with years ago, who were very, very large traders, and I ran a big trading book at Macquarie for a long time, we'd probably have 4 or 5 absolute bang on knockout ideas every year. I mean, real big, go all in kind of trades every year. Now, the trick is to spot those 4 or 5, obviously. And the trick then also for traders is not to be distracted by the 35 other ones that you think are part of the 4 or 5, and get kind of lost in the noise of doing too many trades. And for a lot of people, making money through trading is all about freedom. It is about making money, but it's also about freedom, not having maybe a boss to tell you what to do, having the ability to do it from anywhere in the world, and to do it in your own time, which is fantastic. What you don't want as a trader is to be glued to that machine constantly, because then it becomes a job. And also then it becomes, you're sitting there and you feel like you need to trade. You feel like you need to justify being in front of that screen. And I think it's important to know when to be patient. Kenny Rogers, you got to know when to hold them, know when to fold them. But you got to know when the conditions are right, when the risk reward is right as a trader to take on that trade. Just doing it for the sake of it. I've seen, we used to have a big sign on the desk saying boredom trades cost money, and it is. People, they're in front of the screen, something's happening, they feel they should be part of it. They're not really sure why, but they feel they should be part of it. And it goes back to your trading plan, Louise. Have a plan, stick to it. Don't get sucked into, oh, this is moving, I've got to get involved, because boredom trades do cost money. Try and focus on the risk reward trades that are really going to make you good money without too much risk, and go bigger into those trades. And if you've only got 4 or 5 of those a year, that's probably all you're going to need if you size the position correctly, rather than getting caught up in the day-to-day. I'm going to do 10 trades today, and it's a law of probabilities at the end of the day. Most traders are happy if they make 4 out of 10 trades are really good, and 6 they cut really early, and they don't make too much money either up or down on those 6 trades. If you can make half the trades you do really profitable, and the other half are basically a wipe, you're doing really, really well. But the more trades you do, it's like betting against the casino. The more times that wheel rolls, the worse it gets. Pick your moments when the odds are in your favor.
Yes. And I do think that comes down to identity as a trader. So many traders think that they have to trade short term. They have to be in the market all the time. They have to be in front of their computer. All of these things, they may be true, but for you, they may not be. They don't have to be. One of my top traders, she is a nurse. She works night shift. She has got a farm. She is incredibly invested with her social life and her personal life. And she probably only does, maybe 3 trades every month, maybe not even that. And she is making spectacular returns. So I don't think it is something that we have to get caught up with what the media has fed us, that we have to be this way to be able to make money. And Henry, that's one of the reasons why I love having your companionship, because you always make me think about things in a different light, and you do confirm a lot of the things that I've been thinking as well. Because technically, I guess, generally people think fundamental traders and technical traders should be at each other's throats. What do you think about our rivalry?
Louise, this has often puzzled me. If you're going to go into battle and battle the market and battle other investors and other people's views, then to me, being armed with as many tools as you possibly can, being armed with as many weapons as you possibly can, makes so much sense. Why would you fight with your one arm tied behind your back because you don't believe in technical analysis? Why would you fight with the other arm tied behind your back because fundamental analysis is a waste of time? The two can coexist, and I think it's one does not preclude the other. It may be that you look at a stock from a fundamental position and you go, okay, well, I like this stock because of these reasons. It's on a low PE, it's got a high yield, it's got catalysts in the business which are going to help it re-rate. And then you look at the charts, then you go to the charts for timing, because that's all important. But to just close one eye and go, you know what, all I'm going to do is look at the charts is it works for some people, and to be honest, it does work in some instruments. And if you've got 24-hour trading in some instruments, that may be worthwhile. But in the Australian stock market, which I've been doing since 1989, we close every night and we reset in the morning, and things change overnight, and companies come out with results, companies come out with updates, there's AGMs. So unless you kind of know the background, when the AGMs are due, when the results are due, what to look for, what the market's going for, what the catalysts are going to be, what the headwinds, what the tailwinds are going to be, you're really only working with one arm. So why would you not equip yourself with as much information as you possibly can on your investment choice, and then look at the technicals? And then if you just looked at the technicals, then maybe look at the fundamentals afterwards, whichever order, it doesn't really matter. But I think it's, for my investment journey, it's always been the sum of both, which I think makes it better than just going, oh, this looks great on the charts, and then a day later, you short this thing and it gets bid for, and the bid rumors have been out there for a few days, and you're staring down the barrel of a 20% loss, or some update comes out because there's something happened macro that you haven't contemplated. So why would you fight with only one arm is what I would say, Louise.
I like that. So look for the similarities between our methods rather than the differences, because I think
celebrate them.
Yeah, exactly. It can all feed in. So I'm going to give it a shot at summarizing this episode. I'm working without a net here, Henry, so you're going to have to catch me if I skip out any aspects here. So firstly, just know that 2025 is going to be a big year. You have to be prepared by having your own written trading plan. And if you don't have one, come to tradinggame.com.au and download mine. I give it to you for free so that you can make a difference this year. Secondly, have a look at sector rotation. We are no longer in the lithium and resource days, and certainly the financial sector was going very well, and so was the IT sector, but who really knows what it's going to be? Because there is uncertainty and you need to base your actions on data. Once you've got the data there, then you can be nimble. Try not to react preemptively and try not to use things that you think are important. Use the data to actually cement your views. The other aspect that we discussed today was ETFs. So using ETFs preferably that are constructed on the same basis as the index, things like the NASDAQ or the S&P 500 or the ASX 200 can be wonderful ETFs to give you that diversity where you can actually trade everything through the one instrument, but it will provide that diversification that you're looking for. And we also talked about keeping yourself emotionally grounded because of these fluctuations. So important to use volatility in your favor rather than being whacked across the side of the head with it. So hopefully I've summed up there, Henry. What have I missed out on there?
No, I think you've summed it up very well, Louise. It's going to be, I think, we've got used to, well, the last 2 years have been exceptional years in the market, especially the last year. It has been extraordinary. Since that pivot with Jerome Powell, when they decided that they would start talking about rates being cut, the market has taken off. And then we had the NVIDIA leg and the AI leg that's really turbocharged that. The question, I guess, for investors is whether 2025 is going to be the continuation of that. And certainly historically, it would appear that that is the way of things. And certainly some of the announcements coming out of the new administration in terms of Stargate, etc., would suggest that that is going to happen. But then, it's a rocky road, and we've seen how rocky that can be. The fall in NVIDIA was bigger than any other previous fall in terms of market capitalization. It was extraordinary. I suspect there's a lot of computers at work there going overtime and also a lot of people with stop losses that just got triggered, a lot of leverage there. This thing will never go down until it does, and then suddenly you come unstuck. So yeah, I think 2025 is going to be a different year to 2024, but far more volatile for investors.
And how can people stay in touch with you, Henry?
They can look at marketstoday.com.au. You can sign up for a free trial to the newsletter there. I write every day for the newsletter on Henry's Take, and I do look at small and mid cap stocks as well as this, but I do look pretty much anything, to be honest, Louise, and market strategy as well. So I try and do that. I run a small cap portfolio as well, which it's probably been a little bit more defensive in the last few months. It's been very hard when you're looking at all-time highs in the market and you look at things, you think, wow, that's expensive. And some of the trades out there, especially at the moment, there's been some absolute crackers in terms of M&A activity. We put on one recently in Insignia Financial, which was a 31% gain after the bid. So that those sorts of trades have been really really good. And again, this goes back to knowing when to go all in, and knowing when there is a good trade that has risk reward in your favor. And those sorts of deals, they're out there at the moment. There's increased M&A activity, which I think is good, and I think we're going to see that increase in 2025 as well. So those should throw up good opportunities as well after the bids, not necessarily trying to preempt who's going to be taken over, but once the bid is announced, especially if you can get two players in the bidding war, that's always very lucrative as well.
And of course, my listeners should be listening to your On the Couch podcast, and the On the Couch podcast people should be listening to Talking Trading. So come to talkingtrading.com.au so that you can get my views as well as Henry's every week. Any parting words, Henry?
I think just keep your eye on the prize, keep your eye on the horizon. Try not to be seasick this year, because it is going to be a little bit more random and a little bit more volatile. But bear in mind, at the end of the day, that the US will do what the US wants in its favor, and will really favor the US in everything. And maybe the US is still going to be the market to invest in 2025.
Magic. So until next week, happy trading.